Are mutual funds that pay higher dividends better than lower-paying dividend funds? Do higher-paying dividend funds charge higher expense ratios? And how can you determine the dividend yield of a mutual fund? We'll answer these questions and more on this, the 98th episode of the DoughRoller podcast.
Welcome to the DoughRoller podcast, where the best thing money can buy is financial freedom. We help you make more, spend less, and invest the rest. And now your host, Rob Berger.
Whether you're just starting out, buried under a mountain of debt, or well on your way to financial freedom, this is the podcast to help you take your finances to the next level. Hey, everybody, this podcast is sponsored by Betterment, the most preferred automated investing service. Betterment has cutting-edge technology to optimize returns, minimize taxes, and save you time and money. Join over 34,000 customers who have already streamlined their portfolio management at betterment.com/roller. That's betterment.com/ROLLER. So today we've got part two in an ongoing series regarding dividend investing. Part one was in podcast 96, DoughRoller.net/podcast 96. And today we're going to go to part two, and the topic is dividends and mutual funds. Since I know a lot of you invest in mutual funds and ETFs, it raises the question, well, you know, do mutual funds pay dividends, and how do you figure out if they do, how much, and should that be a factor in selecting a mutual fund? And I think it's an important topic. You know, for most of this series, we're going to focus on evaluating individual stocks. But I thought early on in the series it would be important to cover this as it relates to mutual funds. Again, because I know a lot of you, that's where you invest most of your money. It's where I invest most, although not all, of our money. And the topic kind of hit home when I received an email from a reader. He asked me not to use his name, so I'm going to call him Frank, not his name. But he had a great email, and actually it raises a number of questions, only one of which we're going to cover today. But let me read you the email, and it'll get us started on today's show. And he says, I'm a 30-year-old investor, and I've been listening to your show since your 30-day money challenge. It really motivated me. I greatly appreciate all the valuable information you have been providing. I'm new to investing, and I have learned a lot this year. I was particularly interested in podcast number 28, where you explain the importance of keeping your fees low. Currently, I'm invested in various American funds, and that's a name of a fund company. And I've been thinking about reinvesting in a few Vanguard index funds. After explaining my reasons to my financial advisor, she is quick to point out that while fees of, let's say, VTSMX, which is a Vanguard fund, 17 basis points is its expense ratio, are low, the total reinvestment isn't as great as that of, for example, ANCFX, an American funds mutual fund, 63 basis points in expense ratios, which I'm currently invested in. She's basically saying that even though the fees are higher, I will still make more money in the long term. As a listener of your podcast, this idea raises a red flag. She mentioned that some funds with low expenses might not take a lot of money out up front, but instead take it out on the back end by not reinvesting as much back. This is the area where I am confused. Could you expand on this? Is she right that getting greater dividends is better than keeping my costs low? After listening to your show, I also started investing in a 401k, unfortunately with no match. At the beginning of the year, my asset allocation was 30% in DODFX, 5% in VBMFX, and 65% in VTSSX. I've happily received a personal rate of return of about 13%. My personal rate of return after all my fees on my American funds IRA is a little over 1%. Also, I am no longer employed at the company. I had my 401k, and I will have to roll it over soon. I am second-guessing my initial decision to roll it over into my American funds IRA and might set up a separate Vanguard IRA. The main question I'm asking is, do you think it is wise to stay with the American funds, and where would you advise I roll over my 401k? I look forward to your insights and suggestions. Thanks so much for taking the time to read this. I really appreciate all that you are doing with DoughRoller, and I can't recommend it enough. If for some reason you happen to use my email in the show, please don't mention my name. Well, I'm not going to, Frank. Appreciate the email. Great questions. Actually, I think Frank's email kind of raises three questions. We're only going to tackle one of them today, although I'm going to tackle the others in future podcasts very soon. So here's how I break down the email. The first question, the one we're going to tackle today is, are mutual funds with higher dividend yields better than funds with lower yields? Are you going to get a better rate of return in the long term if the mutual fund pays a higher dividend? That's the first question. The second one is kind of baked into his whole email. Does historically high returns? This is how I kind of look at the second question. Does historically high returns justify paying high investment fees and costs? This gets at his advisor's claim that if you stick with American funds, yes, you'll pay higher fees, but in the long term, you'll make more money because your returns will be higher than if you go with a low-cost fund like a Vanguard fund. That's the question we're going to cover in the next episode. And then thirdly, where should you roll over a 401k? What are your options? That's what he's wanting to know. Now, I'm not going to give specific recommendations to folks. I'm not going to say you should go invest in this fund or you should go invest in that fund. But I will walk through how I think through these issues. And then, of course, you can decide for yourself what's best for you. So we're actually going to make 3 different episodes out of Frank's email. I think these issues are so important. And the first question just happens to dovetail nicely with the dividend investing series. So that's what we're going to focus on today in part 2 of that series. Are mutual funds with higher dividend yields better than, or will you earn more in the long term as compared to funds that pay perhaps lower yields? So that's what we're going to do today. Let's break it down. And so are higher yields better? And we could look at this at the level of an individual company, right? The stock of an individual company. I mean, of course, mutual funds are just a collection of investments in a number of companies. And so as those companies pay dividends, they go to the mutual fund, and the mutual fund then distributes those to the fund's shareholders, right? So we could look at this at an individual company level. We're going to kind of focus on it at the mutual fund level today. But regardless of how you look at it, the first thing to think about is whether you're investing in an individual stock or a mutual fund is, how do we make money? We get this return, we see this number each year. Where does that come from? It really comes down to 2 things, right? Dividends, right? Any dividends that individual companies or mutual funds pass on to shareholders. And then increased price, right? Capital appreciation. Hopefully the company does well, or the collection of companies in a mutual fund do well. And they have earnings, and folks are, as a result, willing to pay more for a share of that fund or a share of that company. And so total returns, that's a kind of sort of a concept you hear sometimes. Total returns, it's a combination of dividends and capital appreciation, growth of the value of the underlying assets. That's where we get our returns from in our investing. And it comes down to, well, is there one that's more important? Should we focus more on dividends? Should we focus more on capital appreciation? Is there a better or best approach? And here's how I look at it. Regardless of whether you're talking about dividends or capital appreciation, in the long term, they're driven by 2 factors. One is the performance of the company or collection of companies. Are they growing their earnings? Because dividends come out of the profits of the company. If they're not growing their earnings, if they're not increasing their profits from year to year on a per-share basis, they can't increase their dividends. And in fact, if they're really struggling, there could be situations where they decrease their dividends, or in some cases, eliminate their dividends. So dividends are driven by the performance of the company, its earnings growth, and so is capital appreciation. Folks aren't going to pay more for a stock or a collection of stocks in a mutual fund if they're not growing their earnings, right? So whether you're talking about dividends or capital appreciation, those returns are driven by, in the long term, the performance of a company or collection of companies. Now, in the short term, a lot of things can drive the stock market. Things happen in Europe, or the Fed says something, or the president says something, and it can throw the market in turmoil, or it can cause it to go up on any given day. But in the long term, over months, really years, it's all driven by the performance of the company. So both dividends and capital appreciation are fueled by the exact same thing: performance of a company. And it would be no different than if you owned I used in the first podcast in this series the example of a dry cleaner. It'd be no different if you owned a dry cleaner. You could the value of the company could go up year after year as you grow the earnings of the company and reinvest those earnings back in the company. You could also pay yourself a dividend from year to year if you wanted to take money out of your investment. But at the end of the day, both of those are going to be driven by a good business model that you execute well and hopefully grow your business from year to year. So it's no different if you're talking about a dry cleaner or Berkshire Hathaway or Apple or Ford. It's the same concept and principle. Total return, dividends, and capital appreciation are driven by the performance of a company or collection of companies. So that's the first of two factors that drive your return. What's the second one? The price you pay, right? You can invest in a great company, but overpay. And if you do, it's going to hurt your performance in the long term. So, it's a combination of those two things, company's performance and what you pay for the investment. And that's why, they say you want to buy low and sell high, right? So the price you pay is really, really important. And the company having a good business model in a good market, executing well, growing their earnings. That's what drives our returns, whether we're thinking about dividends or capital appreciation. So with that now, let's look at some companies where dividends maybe don't drive value as much as you think. So there can be companies that pay a high dividend yield, but over the long term probably will underperform the market, or certainly won't significantly overperform the market. And there are companies that don't pay any dividend at all and have done quite well. So let's look at a couple examples. The first example would be a utility. Utilities, as are highly regulated. The prices that they charge customers have to be approved by the government. Utilities have monopolies, and so the government regulates the prices that they charge so that they don't effectively take advantage of us, use their monopoly to charge us too much. And utilities are also very capital intensive. So a lot of the earnings of a utility has to go back into the utility to keep up all of their equipment. And so what you have is a very consistent investment, typically, from year to year, but one in which dividends are usually quite high. The yields on utilities can be quite high, but the growth rate is not tremendous. Again, you've got the government keeping the costs down, and you have a very capital-intensive type of business. And so you can have a utility that pays 3, 4, 5% in a dividend yield, very high, but you won't typically have a lot of growth. Maybe the growth is 1%, 2%. The growth can be very, very modest. Now, the point to that is not that utilities are a bad investment. For that lower growth, you get more consistency and less volatility. But that's an example of a very high-paying dividend type of investment that doesn't have tremendous growth. Now, the flip side is, say, a company like Google. Google doesn't pay a dividend at all at the moment, and yet its growth has been tremendous. And if you'd invested in Google at its IPO, or years ago even, you would have enjoyed a tremendous return on your investment so far. You never know what the future is going to hold, but it would have all been in the form of capital appreciation, not dividends. Now, the point of that is not to say that you should focus on companies that don't pay dividends, because there are other examples of dividend-paying companies that over the years have done very well. Apple is a perfect example. It didn't always pay a dividend. It's fairly recent, but it started to pay a dividend, and it's performed quite nicely. So, the point I'm trying to make is that you shouldn't look at dividends as the best way to get your return. You need to look at the total return, and dividends, I think, can be a fantastic way to earn return. But it's usually because, in fact, I would say it's always because the underlying company that's paying the dividend is doing very well. And so, again, you got to look below the surface, below and beyond just dividends versus capital appreciation to the underlying company or collection of companies. All right. Now, this brings us to the next point, and that is taxes. Dividends trigger taxes in taxable accounts. Capital appreciation, that is the growth of the price of the investment, does not until you sell. So, for example, I've owned Berkshire Hathaway stock for a number of years. I have yet to pay a nickel in taxes. Berkshire Hathaway doesn't pay a dividend, and I haven't sold any of my shares, so I haven't triggered any capital gains. When a company in my taxable account, like a Wells Fargo or Ford or Verizon, when they pay dividends, that triggers taxes for me. Now, again, you're not going to have that issue in a retirement account, but if you have taxable accounts, whether you own individual stocks or mutual funds, when they pay a dividend, that's going to trigger taxes for you, even if you never see the dividends, because they get automatically reinvested back into your investment. Now, again, with the example of a utility company, this may seem like another negative on dividends, and the fact is, it is a negative on dividends. The fact that you have to pay taxes when dividends are paid is a negative. All other things being equal, I'd just as soon have a Berkshire where you've got management that can retain the earnings of the company and do smart things with it. Unfortunately, not everyone is a Warren Buffett, and plenty of managers and CEOs at big companies do dumb things with the extra cash that they have, like acquiring other companies at prices they have no business paying, or buying back company stock at inflated prices. Unfortunately, CEOs and CFOs can do some really dumb things with investor cash at the company. And so in that sense, it's probably a good thing that a lot of companies do pay dividends. But it does sound like I'm being kind of negative here. I mentioned the utilities that are high dividend payers but tend to have mediocre growth. I mentioned taxes when dividends are paid. So it's like, well, why love dividends? Why not just focus, kind of the opposite of what Frank's advisor was saying? Heck, don't give me a fund with high yield. Give me a fund with no yield. Why do we like dividends? Well, again, remember what I said about total returns, dividends, and capital appreciation. What drives it? It's the underlying performance of the company. And the reality is that for a lot of great companies, they pay dividends. And so one of the reasons I love dividends is because of the underlying companies that are paying those dividends. They tend to be more mature companies. They tend to be consistent companies. Paying dividends forces management to think about its investors and to focus on increasing that dividend year after year. And so it aligns management's interests with the investors' interests, which I think is very important. And again, the underlying companies are typically, again, for the good dividend payers that have consistently paid a dividend year in and year out, and an increasing dividend. The companies are great investments, and that's what I love about them. I see the dividends as kind of just an offshoot of all of that. And so in a perfect world, I wouldn't get dividends right now because it just triggers taxes. But these great companies like Apple, one of my favorites, and Wells Fargo, another one I invest in, these are, I think, good companies for me and for my investments. They pay dividends. It's the underlying company, though, that I love. The dividends just help me find them, right? So that's sort of my high-level take on, are higher yields better? Are lower yields better? Well, you got to understand total return and what drives that total return. At the end of the day, what you're wanting are investments in solid companies that just happen to pay dividends. Okay, so let's take this all and apply it to mutual funds. The first question is, how do you determine what the yield is on a mutual fund? And it's really actually pretty easy to do. As you might have guessed, if you've listened to my shows, I'm going to go to Morningstar. That's the place to do it. So let's look at Frank's two funds that he mentioned in his email, VTSMX, a Vanguard fund, and ANCFX, an Americans fund. So if you go to if you go to Morningstar and you type in the ticker, VTSMX, this is the Vanguard Total Stock Market Index Fund. It'll bring up a snapshot of that fund, the current price of a share, the expense ratio, 17 basis points. It'll show its turnover, what percentage of its assets does it sell each year. That can be important in taxable accounts because it gives you an idea of what kind of capital gains you might be facing. Its turnover percentage is very small, 4%. And one of the other things it tells you is TTM yield. So what does that mean? TTM, trailing 12-month yield. What Morningstar does is it adds up all of the dividends that the fund has paid out to shareholders over the past 12 months, adds those up, divides by the current price. So in the case of the Vanguard Total Stock Market Index Fund, its trailing 12-month yield, 1.66%. Okay, so how does that compare to ANCFX? Well, if we put that ticker symbol into the Morningstar tool, and pull it up, we see that its yield is 1.22%. So its yield is actually lower than the Vanguard Total Stock Market Index, which is kind of chuckled when I read Frank's email and I looked those both up because I didn't know their yields off the top of my head. And so, I mean, if yield is what you're going for, you'd actually be better off with the VTSMX, the low-cost Vanguard fund, than you would the higher-cost American funds mutual fund. So I'm not quite sure what his advisor had in mind. But if you're going for yield, you'd actually go with the low-cost fund. Now, one thing I will say, and the advisor is absolutely correct, that with your dividends, whether you go with a higher yield or lower yielding fund or stock, you absolutely want to reinvest those dividends back into your investments. You want to reinvest those dividends. Again, you may be in retirement living off dividends. That's a different matter. But like in Frank's case, still young, saving for retirement, reinvesting dividends makes all the difference. It's night and day. I mean, over the course of 20, 30, 40 years of investing, the difference between spending your dividends and reinvesting them is night and day. I mean, it's you take the power of compounding, and it's simply night and day. You absolutely have to reinvest your dividends, and that may make you think, well, if I have higher dividend yield, that will give me more to reinvest. Well, that's true, but again, we're only focusing on the dividend portion of the total return. Again, when you have higher dividends, you tend to have, all other things being equal, slightly lower growth, right? Because the company is not reinvesting more of its money back into the business. Instead, it's giving some back to investors, right? So you've got to kind of be careful about that. You got to keep in mind that the dividend portion is just one part of your total return. The fact that an investment has a higher yield doesn't mean that its total return will be higher. But regardless of that, the advisor is absolutely correct that you want to be reinvesting your dividends. So that raises a question, okay, if yield of a mutual fund is maybe not the best way to pick a fund, then how do you go out picking it? What do you look at? Well, we've kind of been through this, so if you've listened to all of my past podcasts, you know what my answer is going to be. But for those of you that haven't, let's just kind of real quick go back over it. Step one is an asset allocation plan. Step one is forget specific mutual funds for a moment. If your first question is what mutual fund should I invest in, you're not going to have a basis to make that decision. So the first thing is an asset allocation plan. How much do you want in stocks? How much do you want in bonds? For the stock component, how much do you want in U.S. companies? How much do you want in foreign companies? You may ask other questions like, do you want money in emerging market funds? Do you want money in REIT, which are real estate investment trusts, and REIT funds, right? You may ask, do you want money in small cap, smaller company funds versus larger company funds? However you slice and dice it, the first step is an asset allocation plan. If you want more details on that, check out podcast 25, DoughRoller.net/podcast 25. Step two is to find mutual funds that can help you execute on that plan. So, for example, if part of your plan is to have a mutual fund that covers the U.S. market, then you're going to want a mutual fund that, covers the U.S. market. It's pretty simple as that. And I always focus on low-cost options. And if you want the details on that process, check out podcast 26, DoughRoller.net/podcast 26. But here's the thing for today's topic is when I look at mutual funds, I am looking for funds that cover that part of my asset allocation plan in a way that basically mirrors the market. So, for example, for the U.S. portion of my plan, I am looking for an index fund that either covers the S&P 500, which are for the most part, the 500 largest companies in the U.S., not quite, but certainly 500 very, very large companies in the U.S. market. Or you could go with the fund that Frank mentioned, the VTSMX, which is a little broader than that. It's the Vanguard Total Stock Market Index Fund, and it covers more companies than the S&P 500. I think those are both be good options, but I'm looking for a fund that covers the entire, in this case, U.S. market. So what does that mean? Well, it means I'm going to have a fund that invests in Google, right, which pays no dividends. I'm going to have a fund that invests in utilities that may pay a very high dividend yield, but that don't have quite as much growth potential. And I'm going to invest in companies in between, right? Like a Wells Fargo, for example, that's a solid company, in my opinion, pays a dividend, and at least when we're not in a financial turmoil like 2008 and 2009, generally increases its dividend. So I'm going to cover a little bit of everything. And why am I going to do that? I'm going to do that because I don't believe most actively managed mutual funds and the managers that run them can, in the long term, beat the market after expenses. I don't think they can do it. More importantly, if there are a few that exist today that can and that will do that over the next 40 years, right? Or 20 years or however long you're investing, I have no way of knowing who they are. I mean, I could certainly look at history and say, well, this fund has beaten the market for 20 years, but I have no way of knowing if it's going to continue to do that for the next year, 5 years, 10 years. I have no way of knowing. I could take a chance, but I figure, well, why take a chance with my retirement when I don't need to? Because even if it does beat the market, it ain't going to beat it by much. It's going to be really close to an S&P 500. The odds of it clobbering the market over the next 20, 30 years are basically nil. And again, I won't know which one will do it. I can tell you a quick story. When I was beginning to invest, I invested in a fund run by Bill Miller at Legg Mason. It was Legg Mason Value Trust, and it was one of those funds that beat the market for, I want to say it beat the S&P for 15 years. A tremendous track record. And I invested during that time. And as I learned more and more about investing, I concluded that, one, it was unlikely that he will continue to do that during my lifetime, during my time of investing. And two, when he does start to underperform the market, am I going to be willing to stick with the fund? Or am I going to be concerned that the manager and his team maybe have lost their touch or just made a bunch of bad decisions? Am I going to be able to stick to my plan and not pull out of the fund when the market's going down and the fund is not doing well? And I concluded that no, I wouldn't be able to do that. So I left the fund during its heyday and moved predominantly to index funds. Again, I wouldn't say that there's never a time when you should be in an actively managed fund. But for the U.S. market, pretty rare. There are other markets where managers can maybe add more value, in my opinion. But in any event, I pulled out, and sure enough, eventually, a few years later, the fund just tanked and had a number of bad years. I think Bill Miller is a phenomenal money manager, but it's very, very difficult to beat the market year in and year out, decade after decade. And again, even if some funds are going to do that starting today over the next 20 or 30 or 40 years, how are you and I going to know which funds do that? So again, I start with an asset allocation plan. I then look predominantly to low-cost index funds to cover and execute on that plan. That's my approach. Now, it's interesting. Frank in his email mentioned DODFX. That's the Dodge & Cox International Fund. It's an actively managed fund. Its expense ratio is 64 basis points, which for an actively managed fund is actually pretty good, obviously more than an index fund. Dodge & Cox International stock, it has a yield of 1.51%. This is a fund I own. And you say, well, wait a minute, Rob, I don't get it. You've been preaching index funds, and now you're telling me you own Dodge & Cox International Stock Fund, 64 basis points? I do own it. I own it for a couple of reasons. One is it's, I think, the best international stock fund available to me in my 401k. So that's the first reason I own it. And I needed international exposure in my 401k, and so I've picked DODFX. Secondly, though, it's in a market that probably I think money managers could add more value than, say, the U.S. market. The international market, they talk about how efficient a market is. I think the U.S. market is probably the most efficient out there, and so it makes it very difficult to beat the S&P 500. But on international funds, emerging market funds, I'm not saying that I always use actively managed funds. My emerging market fund is a Vanguard fund, and it's an index fund. But with Dodge & Cox, I think the management there has done a really good job. I've owned it for a number of years because it's been in my 401k, and actually have been very happy with the performance. So I don't want the takeaway to be here that actively managed funds are always bad and you should always avoid them. At least that's not my view. But as I've said repeatedly, the core of my portfolio is in passively managed index funds. Do I own actively managed funds? I do. By the way, this may surprise some of you, but Vanguard actually has some actively managed mutual funds. Now, the last thing I want to mention is there are mutual funds that do focus on generating higher dividend yield. They focus on companies that pay a high dividend yield and have continued to grow their dividends from one year to the next. And as an example of that, you can look at VHDYX, which is a Vanguard fund. It's a Vanguard High Dividend Yield Index Fund. This is the investor shares version of their fund. And when I pull it up on Morningstar, so remember, the S&P, the total stock market index fund, had a yield of, I think, 1.66%, right? The Americans fund, we looked at 1.22%. The Vanguard High Dividend Yield Index fund, 2.75%. So a significantly higher yield. Now, again, how would I look at that fund? Would I evaluate it and say this is a good fund because of its higher yield? Actually, what I would look at is how this fund is structured and what kind of companies it invests in. I may like this fund a lot if it's investing in very solid companies that consistently pay a higher dividend and can buy those companies at lower prices, so a value-focused fund. Now, I've not studied the Vanguard High Dividend Yield Index Fund, so I don't know exactly how it's structured. But I mention this just to sort of showcase the fact that there are mutual funds, and Vanguard isn't the only company that has them, but there are mutual funds that do focus on higher dividend yield. Now, in a taxable account, I wouldn't be so excited about this option because of the taxes that I'd be paying every year on 2.75% yield. So, but I wanted to mention it to you just to kind of show you what is out there, what is available, things that you might want to consider. At the end of the day, Frank's question is, so should he stay with the American funds option? Well, as I mentioned, I'm not going to give specific recommendations about what someone should do, but I'll give you kind of my thinking, how I go through it. I've done that today in this part 2 of the dividend investing series, but in the next episode, I'm going to walk through how I would evaluate American funds generally versus, say, an index fund. And hopefully that will help Frank. Hopefully that will help you. That's what we're going to do on the next episode. For this show, you can get the show notes. Just go to DoughRoller.net/podcast98. Hope you have a great day. And remember, until next time, the best thing money can buy is financial freedom.